All right, welcome everyone to tonight's Sunday macro wrap up. Well, let me just unmute myself there. Welcome everyone to tonight's Sunday macro wrap up for Sunday, November 9th. We have a decent amount of data to get into from last week as well as this week coming up here. Breaking news though, it looks like the government shutdown is about to end and the futures market is already rising on that optimism. And so we're going to get into that, as well as we're starting to see still, some of the macro data from the private data that we've been getting since the government shutdown has been persisting. That, we're still in this sort of environment where you have weakening sections and then other ones that are gaining more strength, which we'll get into. So it's a little bit of mixed data, but then also as well, we continue to get more inflation concerns from the bond market, which is then showing that the current probabilities of a rate cut in December in just a couple weeks, could be going to a coin flip. So we'll be getting into all of that here in a minute. But yeah, the whole thing that happened last week where we saw a little bit of a sell-off in some of the big tech names, it really was a large correction in semiconductors and a lot of the AI as well as quantum computing stocks. And a lot of people, the big narrative was, is this bubble finally, or has this bubble finally popped? And are we going into a bear market? And, with the narratives that go on in the mainstream media, the answer is obviously no. It was just a slight correction. We'll get into some of the volatility as well as the risk on versus risk off signals in a moment. But essentially, we just saw a little bit of a correction from the huge price appreciations that were going on for the past several months. The markets don't go up in a straight line, and you're going to have corrections. Of course, we want to make sure that for the ones that have lost a lot of trend strength, to essentially get rid of those or be very cautious with adding back to them. So whenever you have a market shakeout, the key thing to notice, so whenever there's a price decline, you always have to take note which ones, barely even had their trend broken, or which ones, are still maintaining a strong trend, and which ones, just completely flopped. So that's really what you have to be paying attention to whenever we have these price declines. But let's go ahead and get right into it here. So this is an article that just came out probably an hour ago that the Senate reached a deal to end the government shutdown. If you go on the whitehouse.gov website, though, it still has their 24 counter counting down, which is pretty funny. But really the key updates here have been that they're going to fund the deal to reopen the government. And I think Trump actually went on TV a moment ago and said, just wait, we'll have a bigger announcement later on. So it's looking like this is going to end at 40 days or possibly, just 39 days. This is the largest or the longest government shutdown in U.S. history, the previous one being from 2019 or from 2018 and 2019. And so that could bring a lot of optimism with, paying coming back, less of a constraint. But then also, too, the other side to that is that we're finally going to get all of the updated government data from what we've been missing over the past several weeks, which was, inflation as well as the jobs market. So it could be a double-edged sword. We will see. But taking a look at some of the data last week, we got PMI numbers, purchasing managers indexes for both the manufacturing as well as services, ISM. And these are leading economic indicators. The manufacturing one is less so because it's really a lesser percentage of total GDP. You really have to pay attention to the services one a little bit more, but it's still important. But taking a look at the manufacturing sector from the data last week is that we had a little bit of an acceleration, or it was a little bit of a deceleration, but still well below expansionary territory. It needs to be above 50 in order for it to be considered expanding. And so it still remains in contraction, since March of this year. we did see a little bit of a bump up in employment that bottomed in July, and since then it's had a 3-month acceleration. New orders still remains relatively low, but again, a lot higher than what we saw back in March of this year. And then prices paid, which attributes to price inflation for a lot of these different manufacturers, that has actually continued to come down for the 4th consecutive month. So that's actually some good news on the prices front. But still, the entire ISM manufacturing PMI remains in contraction. On the contrary, though, services, which is much more important, again, to pay attention to. The reason why is because the United States is more of a services-based economy. Services make up over 70% of the GDP number, so you want to make sure that this one is doing well, and it did have a decent rebound here in October to levels that we haven't seen since February. Now, taking a look at the different components, employment still remains in contraction, well below 50. That's remained that way since June of this year, and it's had a couple months of an acceleration, but still remains pretty low. Taking a look at new orders, that's really where you saw the large acceleration, and you could almost think, a lot of this new orders is because the holidays are coming around, but this is something that is contributing to the expansion for the index itself. And then for services prices, unlike manufacturing, just hit a new relative high. If we go and take a look at the past 10 years here, we can see that the last time that prices paid for services accelerated this much was back in 2021. And so that's really what we're seeing here. Whenever this comes down, whenever this starts to decelerate, that typically coincides with the stock market actually going down as well. As we see, this peaked right around December of 2021, right when the stock market peaked, and then it started to decelerate in 2022. It continued into 2023. So it's a little bit more of a lagging indicator in terms of comparing it to the stock market, but it still coincides pretty well. And as you can see, this continues to rally. So, there's that. We also got the ADP private jobs number last week, which did show a little bit of a rebound with adding 42,000 jobs. Now, that could be a lot compared to the way that the labor market has shrunk considerably. And so we did see a decent acceleration. Taking a look over the past 12 months, though, this still is a pretty low number. But, I think with the way that the labor market is now structured, a 42,000 job ad could be a decent amount. But then also the next day we got the jobs cuts numbers. So this is the number of layoffs, and it reached a 22-year high, mainly led by the tech sector. And so when you take a look at this chart, you can see that the number of layoffs for any given October for each year, this was the highest since 2003. So that was a pretty large jobs cut announcement. And typically you don't see large job cut announcements in in Q4, only because a lot of employers are like, we really shouldn't be firing people right before the holidays, especially with the onset of social media, where people can get online and make a viral video, and it actually affects the stock of the company. Pretty much since the 2010s, which is why you can kind of see how that's pretty much been a low level since 2010, and this was a large spike. So if companies are getting to a point where they can no longer be like, all right, we can't honor that unwritten rule, and we're going to have to start laying off people even around the holidays, that really is a tell on how pinched a lot of these employers are, which is typically what happens towards the later stages of a business cycle. And so, taking a look at this report in more detail, you can see that year to date, it's at 2.3 million job cuts, which is the highest level since the pandemic. And yeah, not only that, but when taking a look at the job cut plans in the future, so in the future months, what were they guiding towards? Um, they tracked that nearly 450 individual job cut plans in October, which was compared to 400 in September. But when you go down here, you can see that employers only announced 488,000 planned hires, which is down 35% from this time last year, which is the lowest year to date since 2011. So not only did we get a large spike in job cuts and layoffs for the single month of October, but a lot of companies guided that this is probably going to continue forward with job cuts. So that comment that Jerome Powell made during the last press conference that the labor market was, settling down and not getting worse, that's the complete opposite of what the data is actually showing. And it's no surprise though, because people forget that the Federal Reserve is a private entity. There's nothing federal about it, and they don't have any reserves. In fact, since 2020, they've made it a rule that banks can have zero reserve balances. And so all the money that they're lending out, they don't even have. And so we should always be thinking about, even though, they present themselves on TV with, expensive suits and their buildings are grandiose, and, their buildings are right next to the government buildings in the Capitol in Washington, D.C., they're essentially a mob. And if you go and, read the history of the Federal Reserve, it's essentially it's a giant mob that runs our financial system. It's a banking cartel that's legal, and don't be fooled by their professional speech and appearance. They are straight mobsters. Anyway, they lie to our faces. Anyway, getting into consumer sentiment, we saw for the Michigan report, the Michigan consumer sentiment, that this was the second lowest on record. This is a little bit biased though, because they're kind of leaning in the opposite political direction as the current administration, and so you could get a little bit of a skew there. But if you take a look at another sentiment index, which was the Real Clear Markets Sentiment Index for consumers, that actually had a pretty sharp drop off, which this metric is considered more neutral. They don't really lean political in either way. And yeah, this also showed a huge decline in consumer sentiment, which is just continuing the whole K-shaped economy, where the bottom 50% are just, they've been in a recession for the past 3 years. People who own stocks, own Bitcoin, real estate, and have really hedged themselves, against inflation, as well as the dollar depreciating in value. Those people have been fine, but you're starting to see that more of that upper 20%, they are now starting to feel the effects of this as it goes forward, with inflation and things like that. So the thing about inflation is that it's a silent tax that affects everyone, and sooner than later, it ends up really affecting even the upper class people. So yeah, it's getting to that point later in the cycle. Taking a look at the CPI report, or not the CPI report, but the CPI inflation expectations from the Cleveland Fed, we can see that they have headline CPI remaining around 3% through November, which is a little bit stickier than what had previously thought. And even with the oil rate of change slowing, we can still see that the CPI print is going to remain higher for a lot longer here. This could change going into 2026. My team and I think that we could see a little bit of a rate of change slowdown with CPI heading into next year. But it looks like throughout the rest of this year, these next few months, that it's going to remain higher, which again, that's the reason why if we take a look at the futures market for the target rate probabilities, we can see that there's now a 66% chance that they're going to cut by 25 basis points and a 33% chance that they're going to pause. But this is a large increase from just 1 month ago when there was just an 18% chance that they were going to pause. Now that's, nearly doubled. Um, so yeah, it's this tough battle for the policymakers of, do we continue cutting rates and risk inflation going higher, or do we keep things higher for longer and just, continue to deteriorate the labor market as well as the bottom 50% in the country? Because if they ended up cutting rates to zero, they're not going to do that. But let's say they did. Um, a lot of the assets that the rich people own, those are just going to keep going higher. Stock market's already at all-time highs. Um, you know, you have home prices that are still near their all-time highs. They haven't really come down a lot nationwide, and in some cases they've continued to go up. And so, yeah, I mean, cutting rates to zero here would just continue, raising those prices. And so, if interest rate relief happens for the bottom 50% of the country, but then prices, go up by another 50%, is that actually helping? And at that point, they would have to just raise rates again, and then you would get this whole thing, circulating. So that's the whole dilemma that they're trying to balance. And yeah, they're just going to continue to take their time. And with that, they are running the risk of something breaking, which is typically what happens according to history. There have been times where they have achieved a soft landing, whereas they started to cut rates after tightening and nothing happened. But there's about an 80% chance of that not happening. When taking a look at the current SOFR watch tool here, we can see that it was pricing in 4 rate cuts in 2026, but now it's just pricing in 2 rate cuts. So the amount of rate cuts projected for next year got cut in half, one being in April, just a 25 basis point cut, and then the last 25 basis point cut being in July, and then them not cutting for the rest of the year next year. And there's even, as of right now, no price cuts heading into the end of December of 2027. So this could change, but as of right now, if things don't change, July of 2026 could be the last rate cut for 2 years. And then, rates would stay around 3%, which is a lot higher than 0% over the last 15 years. So yeah, for the people who are calling for rates to get cut to zero, that's definitely, I mean, never say never, but it's not the base case right now. But who knows? Maybe dropping it to 3% and achieving a soft landing is possible. We'll see. That's kind of the long term here. Let's take a look at if there's any updates on the government reopening. CBS News here has been giving some decent updates. Looks like there hasn't been any other updates here. But yeah, it looks like they are coming to an agreement, and we should be getting some announcements here either in the next couple hours or even in the morning. And so let's go ahead and take a look at some of the price charts here. We'll get into this in a second, this little graphic that I came in. But as you can see from the macro data last week, it's a little bit mixed. Labor market and the bottom 50% are still struggling, and services looks like it's not, dropping off too bad. So there's nothing to panic right now on. So I would fade a lot of the fears that happened last week. And then hopefully if the government reopens, we can finally get CPI data, which is supposed to come out on Thursday of this week, on Thursday morning at 8:30 a.m. And then we get PPI on Friday, so as well as PCE numbers. So hopefully we'll get those, and we'll get a full, fresh, updated inflation report numbers from the government, but we will see on that. Taking a look at some of the things that were performing last week, pretty rough week. We saw that mostly everything was in the red. The things that were least in the red were silver, gold, and the dollar. So those were the best of the worst last week, which we also had a little bit of a nice little rebound in Bitcoin, but still, it's still in the negative oil as well as the S&P 500 did have a decent negative week last week, mainly driven by the tech sector as well as discretionary. So out of all 11 sectors of the S&P 500, the worst performers last week were the tech sector as well as discretionary. The best ones that performed was actually the energy sector as well as real estate. So that was pretty interesting there. A little bit of a risk off type of environment with a little hint of potential stickier inflation. And then when we zoom in on the top 10 stocks in the S&P 500, we saw that the worst performer was Nvidia last week. The best performer that held up was Apple, but really you saw a broad decline throughout the week on the Mag 7 stocks. And there was really just a shift into value from growth. And, again, things don't go up in a straight line. So you're going to have some of these reversals. And what I mean by that is if we take a look at a ratio between growth, a growth ETF as well as value ETF, we can see that that's just the case and growth still remains bullish here. So let me see. All right, so this is the growth ETF IVW versus the value ETF IVE ratio. And so as you can see, even though it did have a decent decline here, it still remains in bullish trend. On this drop off though, it has lost a little bit of momentum, but as you can see, it still clearly remains in a bullish trend here. So if anything, last week was a great week, was a great week to look for different things that had a correction that still maintained a very strong bullish trend. And so that's what we were taking a look at as a team there. Looking at the S&P 500 with the ranges heading into tomorrow, you can see that on Friday, it did tap down into the low end of the trading range zone. This is in our trading ranges model that our team created. And so typically when something's in bullish trend and it reaches the low end of the trading range zone on lower volume, that is a very great buying opportunity. And, that has happened on numerous occasions for the S&P over the past, couple months here. So we'll see if that's the case again, potentially with the government shutdown ending, you could potentially get a lift in a lot of the things that were down last week. So let me just take a look at the futures market here. Yeah, so we could potentially see a little bit of a rebound since I'm looking at ES right now, the S&P 500 futures, and it is having a little bit of a pop. So yeah, that could be just what's happening. Taking a look at a chart of Bitcoin, Bitcoin still remains in bearish trend, and it looks like it's also having a little bit of a bump here on this government shutdown ending news. Stepping back a little bit, taking a look at the medium to long term, we still have what's called a bull flattening in the yield curve. And my team and I track the yield curve. It's one of the best leading indicators for the economy. The bond market is, still to this day, considered smart money. And so you want to pay attention to what the bond market's doing, specifically the yield curve or the spread, the difference in percentages of the 10-year U.S. government bond yield and the 2-year U.S. government bond yield. And as you can see, since April, it's remained relatively flat. And typically what happens after, a period of flattening, you get some type of steepening, whether that's from the Federal Reserve cutting rates in an emergency liquidity environment, which if that's the case, similar to kind of what it was pricing in back during when we had that large correction earlier this year for the tariff tantrum, we could, if this ends up spiking because the 2-year dropping, we could see a similar correction in the S&P like we saw earlier in the year. If it's the opposite though, if it starts to steepen because the long end of the curve is rising, that would actually be more of a growth recovery signal. And so, as you can see, two steepenings aren't created equal. We have to see in which context it is steepening. And you don't just look at the yield curve by itself. You have to look at other macro indicators, but it's still remaining relatively flat. And the market can perform well. It has performed well in a bull flattening environment because it's basically pricing in that we're going to be going into a bear steepening from here, which again, that's when the 10-year yield is rising faster than the 2-year, and that's typically more of a soft landing type of signal. So we'll see which one happens. We'll be able to keep you guys updated and let you guys know what we think on that. But yeah, what you can pretty much describe last week is just a little bit of a handoff from being extremely bullish to a little bit less bullish, and really it's just focusing on the best winners, which currently right now it is healthcare. The healthcare sector has been the best performer, as well as the quality mega caps such as Google, as well as Amazon and some of those others. Meta, Microsoft, those have not been the better performers, so you can't treat all of the Mag 7 stocks equally. And I think that there's just more of a hyper concentration into these large mega caps. So you just have to be selective. Couple of things that my team and I were looking at where it could be a little bit tricky is that when taking a look at some of the risk indicators. So let me just see here. One being the US dollar. Right, so the dollar remains in bullish trend, and whenever the dollar is bullish, it's typically not great for emerging markets. So foreign equity markets as well as foreign currencies, and because a lot of these foreign countries are denominating their debt in dollars, whenever the dollar increases in value, that puts a lot of strain on a lot of foreign-based debt, and that could cause a lot of carry trades to unwind. And one of the main metrics that we track for that is actually the USD, so the US dollar versus Mexican peso. And I think it's similar to the Japanese yen in the fact that whenever things start to happen or whenever there is tightening liquidity signals, you get a bullish USD MXN. And this had been coming down pretty much the entire time, after the spike that we saw back in March of this year. And so whenever this is bearish, that's typically a good signal for risk on type of environment and assets. And so as this has kind of gotten less bearish, that has piqued our interest on, okay, maybe liquidity signals could be tightening from here, especially with a bullish dollar. While at the same time, you have had a little bit of an acceleration, a little bit of widening in credit spreads, although it still remains pretty narrow, but it has had a large jump compared to the last 5 months, the last 4 or 5 months. And so when that happens, that could have a negative effect on small caps as well as other liquidity sensitive assets like cryptocurrencies, which makes sense as some small caps have been losing strength recently, and then the cryptocurrency market remains bearish. So, that has also risen. We also had, if you guys remember the scare from the previous week, when looking at SOFR versus the interest rate on reserve balances, that had that large spike up here. And when this starts to widen, that's typically a huge, tightening liquidity signal. And yeah, we haven't seen this really. It doesn't go back far enough on this chart, but we haven't seen that really since the pandemic. And it has been rising steadily and making a series of higher highs and higher lows since August of this year. And so with that spike, it has come down, which has eased a little bit of the liquidity tightening fears, but it's still that level, even though it's come down a lot, remains higher than, the previous 6 months. And so we're not declaring that this is a totally risk off environment. It's just less risk on, and you have to be highly selective. We are starting to see a little bit of cracks in the liquidity indicators as we see here. And if that continues, then I wouldn't be surprised if we saw larger corrections, which, if that happens, we'll adjust from there. But, that's typically what we look at and what we are seeing right now. What's interesting too is that, what's been going down less has been gold. So gold has actually peaked up a little bit here, and the price of it for tomorrow has already started to spike a little bit. If this continues higher on higher volume, then on the next dip that gold provides, I will probably be adding more aggressively. I still own a bunch, but I just haven't been adding to it. And so if this ends up gaining trend strength back, then on the next dip, I will be buying more aggressively on this. So that's one thing that's interesting too. Gold remaining gold continuing its strong bullish trend amid inflation expectations remaining stickier, at least for the medium term. So, maybe over the next 3 to 4 months, we could be returning to more of those stagflationary type of a more stagflationary type of environment. So that's what my team and I will be looking for here. All right. What else? Yeah, that's pretty much all I have for the updates here. Ultimately, though, and we'll go ahead and end on this, for those people who are on the Zoom call, we'll just hang on because we'll go ahead and log off from the stream. But essentially what's continuing to happen, and this has been going on since 2023, is this no landing, stop, go cycle that the market has been experiencing, where, and I've described this before, but I wanted to put a visual up there. If you start with the go, right, that's kind of where we were. Dovish Fed expectations, rate cut expectations, soft landing optimism, stocks are going up. All right, let's go. Typically, when you are managing those and in our model with our group, whenever, there's a lot of euphoria from that go phase, and we start to see the main indices such as the S&P 500 and QQQ, whenever they get to the top end of the trading range on lower volume, that's when you want to sell some, because we could be getting into a scenario where we could be getting higher inflation expectations because of all the bullishness, right? A dovish Fed, rate cuts, that could cause inflation to remain stickier, which is kind of what we're seeing now. So sell some on that euphoria. And then the markets stop again, where, because of the rising inflation expectations, this causes a more hawkish Fed, maybe a rate pause instead of cuts continuing. Stocks have a little bit of a correction, and then the sentiment is hard landing fears or recession fears. And then once those fears drop to lower volume near the low end of the trading range on the indexes that we track, on lower inflation expectations from things being worse, that's where that typically since 2023 has been a great time to buy some. And then around the cycle we go again. And this cycle will continue until we get a hard landing. Even if we achieve quote unquote a soft landing around that 3%, I still think that would just be kicking the can down the road for a larger correction later on at some point in the next 3 to 5 years or something like that. But yeah, that's pretty much what we've been doing the past 3 years heading into, or 2.5 years heading into 2026. And yeah, so we could be in this buy some phase coming out of the stop and about to be going back into a go phase. So that's what we were looking at there this week with my team. But But yeah, so for those who are on the stream, the way that these Sunday macro wrap-ups work is that the first 30 minutes, the first half is streamed on our socials, and then the second 30 to 45 minutes, the second half is offline for our Macro Optics members. If you guys are interested in that, you can just take a look at the website, macro-optics.com. Right now we're doing a 6-week challenge. The link is in the description below if you want to find out more about that. And so, yeah, you can learn more about that there. But appreciate everyone for joining the live stream here. People on the Zoom, hold on, let me just exit out of the stream. And good luck out there this week. Bye, everyone.